All right, we're right at 3:30. Give it a couple more minutes for folks to join, but we'll get started in short order here. My name's Damian DeStefano. I'm the director of the Delaware Division of Small Business, and I want to thank all of you for joining us today. We're here to talk in a little bit more detail about the grant program that Governor Carney announced last week for small businesses in Delaware. We're using a portion of the funding, the federal stimulus funding that was provided to the state to reimburse small businesses in Delaware for some of the expenses they've incurred over the last few months when we know that their revenues have not been where they expected them to be coming into 2020. With that, I think we'll get started. People join, they can come in and pick up where we are. First, just a procedural thing, questions as we go. I know I mentioned this right before we started, but folks have been joining since then. Please post all questions in the Q&A box. We cannot follow questions in the chat because people comment, people respond to questions or the like, and we won't be able to answer any questions in the chat. So please post them to the Q&A box. I can't promise we'll get to all of the questions that are in the Q&A box either, but we will do our best to try to address them. And if not, it might be in some cases just a question that's too specific to a particular business, or we might just run out of time. Please, you can always submit you'll have an email address, you'll have a website at the end we'll show you where you could go to find an email address of your local business manager, so you can submit your question that way. So we will try to get you an answer, okay? And just before we get into the meat of the grant program, wanted to clarify something. There was a question coming out of the announcement last week by Governor Carney around if Newcastle County businesses, the grants were only going to be available for Newcastle County businesses. I think it stemmed from the fact that Newcastle County was partnering with the state in funding the program. The reason Newcastle County, well, let me just clear that up front. The program is the same for businesses from any county. If you're from Sussex, Kent, Newcastle, you're eligible for the same amount of funding. It's all dependent on your revenue, and we'll get into that during this presentation. It's a big part of the presentation, but I just wanted to clear that up. A Newcastle County business with the same revenue as a Sussex business or a Kent will not get anything different. It's just a result of the fact that Newcastle County did receive some of the federal CARES Act funding, and so is partnering with the state to provide a portion of the funding for those Newcastle County businesses. So just wanted to clear that up. We've been getting a lot of questions since the announcement last week. Given that this is the Sussex County presentation, felt appropriate to mention that at the outset. All right. So Governor Carney announced this last week. A little bit of an idea of the timeline. We're in late August right now. The application is going to be completely online. You'll apply online. You'll have a user account. And you'll be able to get status updates through the online web portal. That's not live yet. That will be live in early September, at which point we'll consider that round one. We're not making all $100 million of funding available when that opens in early September. We'll be making a third of it, at least $30 million, available in early September when that portal opens. But then we'll be holding a portion back and releasing it in early October and early November. To release the full $100 million over that 3-month period. The reason for this mostly, we'll get into some other reasons, maybe why it might be advantageous to you as a business owner, even if you're ready to go in September, to wait to November. But the main reason is we saw with some of the COVID programming earlier this year, cases where particularly the smallest business, the owners of the smallest businesses, maybe didn't learn about some of those opportunities right away or with the speed of some of the other businesses. And by the time they learned about the opportunity, the funding was exhausted. And we didn't want that to happen in this case. So we're staggering the release of the funding, give a chance for people to learn about it. Don't put them at a disadvantage if they learn later. If you learn earlier, I mean, you're all on here today, so you're in that crowd of people who are going to be aware of this when it opens in early September. That's good. You'll benefit from that in the sense that you'll be able to apply in September. You'll be more likely to get your funding early on. But if you don't get it in September, you'll have to reapply in October and then again in November. I want to make something clear just about kind of the level of funding and the number of people who will get it. We estimate that we'll be able to reach about 3,000 businesses with this funding. So this isn't a situation where, it's hyper competitive and only 5% of the applicants will be able to get a grant. We don't know exactly what the total pool of eligible applicants is because we don't have a precise accounting for every business in Delaware and who's had, the highest revenue losses during this period. But we were able to model it a little bit, and we feel like where we funded this program, we should be able to reach many of those who were hardest hit by COVID-19. So I don't want you guys to panic hearing me say, you might not get it in September. It's not like, 95% of people who apply in September won't get it. We just don't know exactly where volume will be. We hope by the end of November, most people who needed a grant will have received it. And then just a note about the anticipated processing time after you submitted your application. We expect it's going to take us about 3 weeks to get an application processed and get a funding decision out to you. All right. All right, so we'll get right into the meat of the grant here and how much you're eligible for. So you really got to think about the grant in 2 phases, and I like to explain it. The phase 1 is what's the size of your bucket. Phase 2, you got to fill up that bucket with eligible expenses. So part 1, how do you determine the size of your bucket? The size of your bucket is based completely off of your 2019 revenue on your federal tax return. So this could be revenue earned outside of Delaware. It's your federal tax return. We're not using the state tax return. The tax return has to have been filed. So you cannot, many businesses, or not many, but some businesses we've heard from in the last few days have said, what if I filed an extension? Tax returns were already, taxes were due already a little bit later this year, I think July 15th. What if I filed an extension to September 15th? I don't know if you can extend beyond September 15th, but in that case, we would need your filed federal tax return before you can apply. That's for security purposes, to be able to verify that the numbers we're receiving are accurate. If you don't have it in early September when we open the portal, again, just another little benefit of the fact that you won't be at any disadvantage come October. You'll just have to apply in that second round. So once you have that, you really can walk away. I hope you can walk away from today able to figure out the maximum amount of grant that you're able to get under the terms of this program. We've set it up in bands, sort of works like income taxes, and I'll kind of walk you through with a few examples. You carry over the amount from each band to the next threshold. So for revenues between $0 to $500,000, you're going to take 6% of the total revenue earned. So if you earn less than $500,000 in 2019, you're going to take 6% of the amount of money you earned in 2019, and that's going to tell you what you're eligible for the grant. If you made more than $500,000, you're going to bank that 6% up to $500,000, $30,000, and you're going to move on to the next bracket. And then for each dollar beyond $500,000 that you earned until you get to $1 million, you're going to take 4% of those dollars and credit them towards your allowable grant. So again, just to walk through this example, if you earned $800,000 in 2019, you're going to take $30,000, that's 6% of that first 500, and then the excess amount, $300,000, take 4% of that, add it to $30,000, and you'll have your total maximum grant award that you can get. Follow on to the next bracket. It's the one once you get above $1 million in total revenue. And just to clarify, this is your gross revenue or your gross receipts. There's some different terms that people use. The top line number on your tax return before you take any expense deductions, even a cost of goods deduction. That's the number we're using for both 2019 and 2020. All right, so next bracket, 1 to 2.5 million. So you're going to bank the $50,000. That's 30,000 plus 4% of the 500,000 of that second range, 500 to 1 million. That adds up to 50,000. You're going to bank that 50,000, and then for every dollar in excess of 1 million up until you reach 2.5 million, you're going to take 1.5% and add that to the amount of grant that you're eligible for. That continues till you reach 2.5 million. Again, just to continue with the example from last time, you're a $2 million company. You're going to start with 50,000, take 1.5% of $1 million, which is the dollars in excess of $1 million, and credit that towards the grant. At 2.5 million, you've now reached $72,500 in grant funding. You're going to carry that with you And then for every dollar above 2.5 million in revenue, you're going to add 1% to the grant amount until you reach $100,000. That's the maximum grant you can get. That's at about $5 million in annual revenue. 5 million is a little bit below, but you start to get close to $100,000. Doesn't mean you're ineligible. If your revenue in 2019 was above $5 million, we'll get into some of the things that might make you ineligible later on in the presentation, but by no means are you ineligible because you've got $5 million of revenue or because you reach that $100,000 cap. It just means you can't get more. You stop doing a percentage calculation, just say, I've tapped out, I'm at $100,000. That's the most I can get in a grant. All right. So hopefully that makes sense. It's how you calculate the size of your bucket. Just make sure, I mean, you can go back tonight. If you have your tax return with you now, you can do this calculation now and figure out what the maximum amount you'll be eligible for. So like I said, that's the size of your bucket. Next, we'll go to how you fill that bucket up. You fill it up with eligible expenses. The easiest way to think about an eligible expense is it's an expense that you incurred due to COVID-19. It's an expense you would not have made reasonably. Don't expect that you would have made had COVID-19 not happened. There's a few things it isn't. We'll get into expenses that are ineligible, but it's not lost revenue. Even if you can reasonably assume you would have had that revenue. For instance, if there's an event you have every year and you earn, on average $10,000 from that event, and you weren't able to have it because of COVID-19, some of the expenses that are around that maybe we'll look at, but the lost revenue is not eligible to be counted towards your allowable grant. What is eligible? Expenses like an equipment purchase made to make the business safer for COVID-19. This might have been something you did to bring you in compliance with some of the guidelines around COVID-19 safety. Could have been something you just decided to do on your own to make your business feel safer for your customers. These are PPE purchases, face coverings, gloves, cleaner that you wouldn't have in excess of what you normally would have purchased. Plexiglass, I know we see it everywhere we go now. It's great, helps keep us safe. That's an eligible expense. Most businesses did not have, plexiglass at their cash register prior to COVID-19. And then air purifier, things like that. There might be some other things, equipment that's not here. This isn't an exhaustive list, but gives you an idea of what we're looking at. What it isn't is, equipment that you would purchase in your normal course of business every year. So if you're a restaurant, you purchase napkins every year because your napkins only last for a year. That's not a COVID-19. You didn't purchase napkins because of COVID-19. So next category, refinancing debt incurred due to COVID-19. This is, if you had to take out a loan for cash flow purposes over the period of, and I should have said at the outset, the timeline for these expenditures is April 1, 2020 to December 31st, 2020. That means you can look backwards. They could be expenditures you've already made, or they can be expenditures you plan to make. That becomes really important. We'll talk about that a little bit when we get to technological enhancements, some of the ways you might be able to get creative with your grant. But yeah, just keep that in mind. And you don't have to select one at the outset. You don't have to only be ones you haven't made yet, or only be expenditures you've already made. You can mix and match. You can say, if your bucket's $40,000, you can fill it up with $30,000 of expenses you've already made, and then you can fill it up with another amount of expenses you plan to make. All right. So refinancing debt, this might be a loan you took from a bank during COVID-19 for cash flow reasons. Your revenue was down, you had expenses you had to pay, you had to take a loan. Refinance it with this grant, get out from under that debt payment that you would have to make whenever it becomes due. It also counts EIDL loans. So these are the disaster loans available from the SBA. You can refinance that with this. They do come with an interest rate. And so you might want to avoid having to pay off that money. And so that can be something you count towards this. One thing that does not count towards this might be debt you incurred. Maybe you planned an expansion, you were negotiating terms on financing prior to March, and you closed then. That gets into a gray area where it might not count. You didn't incur that debt because of COVID. One thing you just keep in mind here: talk to your lender. Make sure that you don't incur any prepayment penalties by refinancing the debt and just paying them out. You don't want to run into that situation, and it's you would just want to know that in advance so that you just didn't have it as one of your eligible expenses. Doesn't make sense to get a grant, find out later, oh, I can't use this for that, and now you're stuck because you can't spend the money on something if you don't know if it's an eligible expense or not. Next, technological enhancements undertaken in order to adapt your business model for COVID-19. This could be something you already did, something you plan to do. Your customers, we saw this with a lot of small businesses, is before COVID, most of your customers were walk-ins. They came into your store, they shopped, or they dined, or they utilized your service and paid for it. Afterwards, you realized you either needed a website, maybe you didn't have one before, or your website just wasn't in a place it had to be. Maybe it listed your hours, showed your menu, but couldn't take payments, couldn't do reservations, couldn't do delivery, whatever it was. You had to adapt it. That required some significant capital to upgrade that technology. Maybe you built a mobile app because of this. Whatever it was, you undertook a technological enhancement that you wouldn't have otherwise done due to COVID-19. That's an eligible expense. This becomes really interesting too if you haven't done it yet. We've talked to a lot of businesses, small businesses that, at this point, they know some of the investments that they need to make to adapt their business model and bring back some of their lost customer base. The problem is they know those investments on the tail end of maybe 4, 5, 6 months where their revenues have been down significantly. So they don't have the capital they need to make those investments. If that were the case, you could choose to apply for a grant to help you pay for those things and help you pivot a bit and adapt to the changing circumstances that the pandemic has brought with it. So keep that in mind as you apply. Those are really the 3 categories where I'd suggest you look first, just because I think that they are the categories with the least gray area in them. There's still going to be some gray in some cases. I kind of described that when I was talking about the debt, but you're fairly black and white. It's equipment. Did you purchase it for COVID? Great. You could be pretty confident that that's an eligible expense, or it's not. Maybe it's just clearly not. It's those napkins that you purchase every year, and then that's not going to be an eligible expense. You can fill up your bucket with these 3 items. It's just going to be easier for you, because the next 2 items, while they're eligible, are a little bit more specific and a little bit trickier. The first is advertising efforts undertaken as a result of COVID-19. And again, so this is where it gets tricky, because it's not, if you advertise so much every year just in the course of normal business, that's not going to count. You need to be able to say that this is advertising I did because of the pandemic, whether it's, I needed to reach a new communication channel. I previously wasn't doing social media advertising, and the pandemic just forced me to, because everybody was using social media, and I used to just kind of hang signs on, hang advertisements on light poles around town. That's a kind of a ridiculous example, but you see what I'm saying. An easier example is every year I advertise for my annual dinner or my back to school sale, and I did it this year again. That's not going to necessarily count. This is going to be advertising you did because of the pandemic. So you're just going to have to prove that, and it's going to be a little bit harder than maybe these first 3 items. And then the 5th one is a really niche one. It seems like an expansive category at first, but I'll try to explain briefly why it's really not as expansive as it seems. It's fixed expenses accrued during COVID-19. What this is an expense that you would have owed to somebody, whether it's a landlord, maybe a bank, a utility company, an insurance company. And for whatever reason, we saw this with a good number of small businesses, enough that we wanted to include this. Over the months of, say, April to May, the landlord said, look, I know you guys are struggling right now. You don't have to make this payment, but I still need that money. It's your agreed upon money. We're going to increase your rent by X amount starting in June. Your April, May rent's not due, but after June starts, for the remainder of your lease, you pay an extra $100 a month. That's really not all that different from a loan in that sense. That's a loan from your landlord in a kind of non-traditional sense, if you think about it. So we're going to let you repay that. But again, it has to be an accrued expense, which means you're going to have to show it was owed and I was allowed to not pay it. And then it was assessed over the life of my lease, or over, my utility bill went up X until I pay it off, whatever it is. What doesn't count as an accrued fixed expense is, one, if you just got a month where your landlord said, we're not going to charge you rent this month because of the pandemic, or maybe they gave you a 25% discount off your rent this month because of the pandemic. That's not an accrued fixed expense. That's great. We celebrate that happened, but you didn't owe that money. You never owe it. It was just money in your pocket. They reduced the amount of the payment that you owed. All right. Hopefully that makes sense. Finally, expenses that are not eligible. This is by no means an exhaustive list, but these are things that we know people have asked about, and so we just want to be really clear that they're not. Payroll expenses are not an eligible expense. Health insurance premiums and other post-employment benefits that were paid out, not an eligible expense. This includes workers' comp insurance. Inventory expenses, that's either your inventory went up in cost, maybe you had to repurchase inventory because it's spoiled, whatever reason, not an eligible expense. And then finally, I think we've sort of covered this, but just driving the point home, expenses incurred during the regular course of business, something you would normally do. Just so happened it was during the months of April to December of this year, will not count as an eligible expense. So before we move on, a couple notes about this. One, I might be asking, we get a ton of questions, is such and such an eligible expense? Is such and such an eligible expense? Is this or that an eligible expense? We are, for the purposes of this portion of the program, going to be utilizing a third party to evaluate these applications. So when you apply, you're going to list out all the things you think might be an eligible expense. Hopefully they're pretty clear. We're going to then turn that over to a third party who's going to evaluate those things using the definitions you see here and our conversations with them, and they're going to make a determination. Yes, this is equipment that's purchased to make the business safer for COVID-19. And then we're going to rely on their recommendation as to whether it's an eligible expense. What does that mean for you? First, if you have a lot of expenses that are just, you're looking at it and you find yourself asking the question of, I don't know if this is eligible. I don't know if this is eligible. What we would suggest is, I mean, hopefully in some cases, you're going to clearly know this is not eligible. But again, if you're in that situation, what we would suggest, one, reach out to us and try to ask the question, and we'll try to help answer, at least give you a sense. But overfill your bucket. So if you're eligible for a $40,000 grant, there's nothing stopping you from putting in $80,000 in eligible expenses. In fact, we recommend, if you have a lot of gray area expense, if you're feeling like, I don't know if this is clearly an expense due to COVID-19, fill up your bucket maybe 1.5 times or 2 times the eligible award the award you're eligible for. And effectively what that means is it gives you some cushion. So if the folks reviewing look at it and say, you know, this expense is eligible, this is eligible, this is eligible, this is not. If you overfilled your budget, your bucket, you're going to have some wiggle room where they say this is not an eligible expense to kind of take down without cutting into your total amount. What you don't want to have happen is you get your feedback from us and, you know, you were eligible for a $40,000 grant, but you've only had $35,000 of expenses approved as an eligible expense. Because then you're in a situation where you're going to have to make a hard decision, which is, do I take the $35,000, leave $5,000 on the table, and get my cash and you know, be able to feel like I've got my money in my pocket, or do I reapply and submit more expenses? And when you reapply and submit more expenses, you're going to go back in line in the application review process. So that's the risk you're going to take. So you overfill it, gives you some wiggle room. Still might, you know, if you just a lot of ineligible expenses, you still might run into trouble, but that at least provides you a little bit of cushion for a situation such as that. The other reason to overfill, if you have a lot of expenses that you haven't made yet, you plan to make them throughout the rest of the year, you're going to be estimating the cost of those expenses. You might have a good idea, but it's still an estimate. If you overfill your bucket, it allows you some wiggle room. So you got $60,000 in approved expenses, but you're only eligible for a $40,000 grant. We're going to give you $40,000 cash. You're going to go spend that. All of a sudden, the website you were making, instead of costing $15,000, cost $12,000. That's great. You just saved $3,000. If you didn't have wiggle room in your budget, you're now stuck in a situation, though, where you've got to hold that $3,000 and give it back to the state because you don't have an eligible expense to redeploy that money to. If you've overfilled your bucket, you just look, you say, okay, let me just go down my menu, pick an eligible expense I've been approved for, allocate the $3,000 there. The application process is as much about helping you get clarity on how you can spend your grant funds safely as it is about getting you approved for a grant and getting you the money. You'll have the money in hand when you finish the approval process, 3 weeks from when you start applying. But then you'll have to go spend it. And if you don't spend it on an eligible expense, you'll have to repay the money to the state with interest. So you want to be sure that what you're doing is allowed. And that's what the process is about. It's about providing you with clarity and confidence that you spend this money in this way, you'll be able to walk away and not owe the money back to the state. And that is the last thing I want. I know it's the last thing you want. So we're going to try to avoid having that happen. That's really, I think, one of the key takeaways from the presentation today. You want to make sure that you can provide yourself some of that cushion. Now, what does that mean? You get $60,000 in expenses that you've said, you've created a budget for 60,000, your grant amount is 40,000. What do you do with that extra 20, right? From the state reporting perspective, we only need to see that you spent the $40,000 grant we gave you on an eligible expense. If you decide, these are things where I'm not going to pay for this out of pocket if I don't have grant funds to cover it, that's fine. That extra $20,000 that's in excess of that 40, you're not going to have to prove to us that you went out and paid for it. All we care about is accounting for the grant funds we gave you and that they were spent on an eligible expense. So I hope that makes sense. And I'm going to go on to the next slide, which talks a little bit about the eligibility definitions. So how are you eligible for the grant? First, your business must meet an SBA definition of a small business for its industry. We'll have this posted on our website, so you can look up what that is. They're pretty expansive, so it's based on your revenue, also based on your employee size. It's averaged over several years, but it's pretty expansive. They go up pretty high. The easiest way to think about this, just today, if you're wondering if you were eligible for a PPP loan, they use the same criteria. So you had to be within the SBA definition of a small business. So if you were eligible for a PPP loan, you meet that criteria and you're eligible for this program. Nonprofits, you must be a 501c6, or you must be in a disproportionately impacted 501c industry and be a 501c3. We'll talk a little bit about disproportionately impacted industries, I think, in the next slide. It's a really important feature of the program. For 501c3s, you'll need to be in that industry, in one of those industries, to be eligible for this grant opportunity. If you're not, don't panic. Doesn't mean you're not eligible for funding. Many nonprofits will be eligible, who are not eligible for this program, will be eligible for a separate program that the state is standing up. It's just a little bit different how you account for your revenues and such. So there's a program that's a little bit more customized for those needs. It's similar to this in terms of the amount of funding that you're likely to get and the way the eligible expense criteria, but just a little customized to that unique situation. Next, and I hope this is pretty obvious why this is a requirement to most folks on here, at least 51% of your operations must be physically located in Delaware. You have to be a Delaware company. This grant opportunity is not available to companies that are not based in Delaware. We are hopeful that their states give them support. Many other states have, but we're really focused on helping out Delaware companies. It does not apply if you're incorporated in Delaware, but don't really have a physical presence. So hopefully that's obvious to everybody, that one. Next, if you received less than $1 million in PPP funds to date, you are eligible. If you receive more than $1 million in PPP funds, you're not going to be eligible to receive one of these grants, at least in the September round. It's because we want to focus on people who either received less in PPP funding or who maybe didn't receive PPP funds at all. We're not going to care whether a portion of that converted to a grant or whatever, the forgiveness on the PPP loans. If we have a database, the federal government has released the list of companies that got a PPP loan in excess of $1 million. And so we're just going to go off that. And if you receive more than $1 million, you're not going to be eligible, at least in September. We may expand this. We got a question about this in our last presentation. The only reason we would expand it above $1 million, though, is because if we were undersubscribed in the September round or the October round, we got to November and we just had not exhausted all the grant funds, we might move it up a bit. But for the time being, I would assume that you're not going to be eligible for this opportunity when it launches. You are fine if you've received grants or loans from the state in the past. That counts as an EDGE grant, a HELP loan, etc. Those are the two biggest ones, I think. Might be a strategic fund grant, something like that. You're still eligible for this grant opportunity. And I should address with the PPP, this is similar to the PPP loans. We've gotten questions about this. We do count affiliated entities, has been a question. An entity, 2 or 3 entities owned by maybe the same ownership group or with some common ownership. The example of this, I think, that most people know of is like a restaurant group with maybe 3 or 4 restaurants under that umbrella. Each one of those entities, assuming it has an individual EIN or ITIN, will be eligible to apply for a grant, and will be evaluated separately from the other entities under that umbrella. So just keep that in mind if that is your situation. And that was similar to the PPP loans. Each one of those entities could have been eligible for a PPP loan. And again, we'll only look if that individual entity went over $1 million, not the totality within those affiliated entities. And finally, I said there was a couple key takeaways today. This is probably one of the biggest ones. In order to be eligible to keep the money, I said you have to close it out in 2021. You're going to have to close out this grant by doing two things. The first is proving that you spent the grant funds on the eligible expenses. That means you're going to need invoices, you're going to need receipts, you're going to need to show us that you got the state's money, you used it for something that we told you you could use it for. That's to prevent fraudulent behavior, essentially. Number two, you're going to have to submit during that closeout process your 2020 tax return, federal tax return. If your gross revenue in 2020 is not 7.5% lower than your gross revenue in 2019, which is the tax return you're submitting on the front end when you apply for the program, you're going to have to return the grant to the state with interest. And the interest rate on that, it's essentially we're saying you were not eligible for a grant, you're going to have to return that with interest in the form of a loan to the state. And the interest on that loan will range, it's based off the Wall Street Journal prime rate at the time the grant is issued to you. So I don't know exactly where that's going to be. It's low versus the historical average right now, but it's 500 basis points above the Wall Street Journal prime, which equates to a grant of about 7.5 to 8%, a loan of about 7.5 to 8% interest. So it's not an attractive interest rate. You will have the option of either paying it back on the spot with interest accrued over the time period with which you held the grant funds, or that's compounded over the time you held the grant funds, or you'll have a 5-year time window to pay it back to us at the same rate, again with compounding interest. I can't stress enough, this is not meant to get you all in a situation where you owe loan money to the state. I would like nothing more than for not a single one of these to convert into a loan. It's really what we're trying to do is discourage, we're trying to focus on the businesses that were impacted most negatively by COVID-19 and the resulting containment measures. And this is one way to get at that. It allows us to really concentrate higher levels of resources amongst those businesses. And so, but there's no way to know today where you might be. There's no way for us to verify that you're, objectively verify that you're down from where you were hurt really badly by COVID-19. So we're using that revenue number as a way to measure that. We really are trying to discourage people who aren't going to be below that threshold from applying for the grants at all. Again, to kind of focus on those who we know have been most badly hit. As a business owner, you're going to have a decent sense of where your revenue is right now relative to last year and be able to make a judgment of whether or not it makes sense for you to apply for a grant. This is, again, I talked about in the beginning how there might be a couple instances where that staggered timeline for grant applications is helpful to you, where it's going to be helpful. There's going to be a group of business owners, I'm sure some of you are on right now, who look at this and unfortunately are going to say, yeah, I'm definitely below that 7.5% decline from 19 to 20. There's going to be a group of you who look at this and say, I'm just not going to meet this. I've done okay this year, and I'm better than 7.5% down. And then there's going to be kind of a group of people that kind of fall in the middle where, maybe you're down 7.5% now through the year to date, but depending on how the rest of the year goes, and also depending on how kind of the situation with the pandemic goes, you might end up right around that 7.5%. In this case, the fact that we're staggering the application timeframes might be helpful to you because you don't have to apply in September to get a grant. You can wait, you can get a clearer picture of your revenues, you can get closer to the end of the year. You might wait till November when you've got 10 months of revenue history to base your decision off of and then decide to apply. But you do have to be careful because if you come in above that 7.5%, at that point, you will have to repay the funds to the state. So that is a key takeaway from today's presentation. All right, so I talked a little bit when we were talking about nonprofits about this designation of an industry that has had a disproportionate impact. These are industries that were hit particularly hard by COVID-19. Not saying that there are businesses across any industry that have been individually hit very hard, just that through a couple objective measures, these particular industries were hit harder than others. I said there's an objective test here. We didn't just pull these out of thin air and decide, these are the disproportionately impacted industries. There was a 3-part test we applied. The first part 1, which everybody had to pass in order to be on the list, was you needed to have been under strict, your operations needed to have been strictly curtailed by the containment measures that were put in place over the period of April, May, June, and beyond. That means you were either designated a non-essential industry by the state, or maybe you were an essential industry, but you couldn't do most of your operations. For instance, restaurants are a good example of this. They were essential because they serve food, but they could only do dine-in. They could only do takeout. They couldn't do their regular dine-in services. That's a significant control. If you pass that test, you need to pass one of test 2 or 3. Test 2 is you need to have shown, the industry has to have shown job losses in the top quartile of all industries throughout the state as a percentage of total jobs in the industry. So we looked at from January to May, which is as long as we had data, what percentage of jobs were lost in that industry. If you're in the top, if your industry, if the percentage job loss in your industry is in the top 20% of all industries, you would be a disproportionately impacted industry. The other test, most of these on this list passed that test. The other test, though, that we also used is we had some national benchmarking data about on the profit margin of an industry nationwide. If your profit margin pre-COVID was below 10%, you'd also be a disproportionately impacted industry in the sense that you have very low margins as a course of business. It's going to, assuming it would have been much harder for you to absorb the shock of COVID to your revenues over the last few months. So that was the test we used. Again, tried to be subjective when we came up with this list. All right. So what does it mean if you're a disproportionately impacted industry? One, if you're a, and you can find, you see the list here. I'm not going to go through it. Hopefully you all can see it. Well, I will in case there's people on the phone. So you find your NAICS code on your 2019 tax return. And this is either the first 2 digits or the first 4 digits of that code. If it's a 2-digit number, it's the first 2. If it's 4, it's the first 4. It should be a 6-digit number on your tax returns. Code 44 and 45, that's retail trade, is a disproportionately impacted industry. 6116, which is some private instruction, tutoring services and things like that, disproportionately impacted industry. 6244, which is childcare services, is a disproportionately impacted industry. 71 and 72 NAICS code, that's your hospitality sectors, arts, entertainment, and recreation is 71. Food services and drinking places, 72. The cosmetology industry, barbershops, hair salons, massage therapy, things like that, which were hard hit by the pandemic. So what does this mean? What does that mean for you if you are in a disproportionately impacted industry? First, if you're a nonprofit, it means a 501c3, it means you're eligible to go to this grant program as opposed to the other one that the state's standing up. But if you're not a nonprofit, it means 2 things. One, it means that if you went into business between January 1, 2019 and March 15th, 2020, we're not going to require you to show a 7.5% revenue decline from 2019 to 2020 in order to come forward and get your grant. That's, again, if you started business, the day you took your first dollar in payment from a customer. If you're in one of these industries, will be eligible. You don't have a complete revenue history from 2019, so it might be difficult for you to show a 7.5% decline. We're saying if you're in one of these industries, we're pretty confident you were hit hard, and so you're eligible for the grant. And there's going to be a minimum, since we are basing the amount you're eligible for on your 2019 revenue, there's going to be a minimum amount that you'll get in that sense, because you might not have a whole year of revenue to credit towards your grant amount. Second, you'll be able to, and this is an important one, you'll be able to credit any rent expense, any occupancy expense. I've gotten that wrong in all 3 presentations today. I always say rent expense. Any occupancy expense you incurred from April 1 to December 31st. And that is a little bit different. We talked about those accrued fixed expenses earlier here in the eligible expense slide. That's different because this could very well be the rent payment you made in April and for May and for June and for July. You owed it, you made it, or maybe you got a discount, but you still paid some amount. You'll be able to credit that amount as an eligible expense towards the amount of your grant. And in fact, if you are in one of these disproportionately impacted industries, my suggestion to you would be right off the bat, look at if those occupancy expenses exceed the amount of grant that you're eligible to receive. Because if that's the case, I talked about black, white, and gray before in terms of determining whether something is eligible, not eligible. In this case, for a disproportionately impacted industry, a rent expense is about as clear as you can get as an eligible expense. You owe $2,000 a month in rent over this 9 months. You're eligible for $15,000 grant. That's $18,000 of rent expenses. You've got your eligible bucket of expenses right there. You don't have to worry about going way over because you can be pretty confident. Mortgage expenses also count towards this. We've gotten a lot of questions about, your mortgage interest. That would count. The base payment you make to the bank is what we're going to look at. Property taxes, that might take some unwinding, but for the most part, mortgages also count in this. So you can see this applies to disproportionately impacted industries. Important thing that you can claim if you're in one of those industries. If you're not, it doesn't mean you're ineligible for the grant. You're still eligible. You still have to meet, you just have to go off this list of eligible expenses. You don't get that rent expense credit, occupancy expense credit. If you're in a disproportionately impacted industry, you still have to meet this 7.5% revenue drop requirement. You don't get excluded from that, again, unless you started kind of midway through 2019. But if you operated all of 2019 and all of 2020, you're still going to have to show a 7.5% revenue drop, because we know there's people in those disproportionately impacted industries, maybe for one reason or another, just didn't see as heavy an impact as the rest of their industry. So don't think that you don't have to show that. But otherwise, those are the two special things that you get to do because you're disproportionately impacted. So again, just the takeaway: everybody, any industry is eligible. Any for-profit business is eligible, assuming you engage in legal activity, is eligible. Need to fill up your bucket. Maybe a little bit different about how you fill up that bucket. If you're disproportionately impacted, you still have to show that 7.5% revenue decline, whether you're disproportionate or not. It's a requirement for every applicant, every for-profit applicant. So I hope this provided you more information than you had about what the grants mean, and hopefully you'll be able to take advantage of them. But if you want to ask more questions or get updates, and a lot of the information I've just given you is also available here, go to delbiz.com/relief, and also follow the division on social media. We'll be giving regular updates there. We'll be announcing the exact date when the application portal opens on that website, on our social media. That's at Delaware Small Business on Facebook and at DelBiz on Twitter. And then if you still have a question, maybe I'm going to turn it over to Gary for questions in a second. But if you still have a question, doesn't get answered today, or maybe you didn't ask it because it was specific to your business, go to delbiz.com/contact for information on how to reach out via email or phone to get your question answered, hopefully. So with that, I will turn it over to Gary, our moderator, to ask any questions that have been coming across in the Q&A.
Okay, thanks, Damien. Question from a nonprofit organization. They said that the federal tax form they file is a Form 990. They don't see a NAICS code on that form. Is there any other way where they can find it?
Yes, that's a good question. Yeah, it should be on any kind of, if you file employment filings, like an unemployment insurance filing with the state, it should also be on that. You still can't find it, just reach out and we'll help you locate it.
Okay. Question about advertising expenses. Is any type of advertising during the pandemic a qualified expense, or are there restrictions?
Again, it's pretty case specific, and so I'm not going to get into like what kind isn't, what kind is not. The way to think about it though is you're going to have to prove it's advertising in excess or advertising you wouldn't have done had it not been for the pandemic.
Okay. Question about fixed expenses. Is there a definition of fixed expenses that you can give? I think you went over it before, but if you could repeat that.
Yeah, think about it as any kind of, for the most part, it's likely to be any kind of monthly reoccurring expense that you make regardless of your volume sold or anything like that. So the easiest classical example is a rent payment. Same every month, whether you sell X or Y, you have to pay that amount. An insurance payment, also a fixed expense, like a business insurance or liability insurance. Utility payments are a fixed expense. Those are the big ones. Again, though, if you're not in a disproportionately impacted industry, it's only eligible if you accrued it, meaning you didn't pay it got tacked on another month. It's essentially a short-term loan from the person that payment was due to.
Okay. Question about a business that incorporated January 1st, 2020 and had no 2019 revenue. Are they eligible for a grant?
Only if you're in one of these disproportionately impacted industries would you be eligible for a grant in that case. And again, there will be a minimum amount you're eligible for. It will be fairly low, just in terms of we don't know where those it's for everybody that started in that period. It's probably going to be in the range of about $10,000 to $15,000, but you will be eligible for a grant of some sort if you're in one of these industries. If you're not, you will not be eligible because you have no 2019 revenue. So this is a good time to kind of explain for a business that isn't in one of these industries and maybe started in 2019, how that would work, because you are still eligible. We're not saying you're not eligible. The only thing is the 7.5% revenue decline holds that requirement, and you don't get to prorate your 2019 revenues in any way. So say you started operating midway through 2019, you're only going to have 6 months, assuming you operate on a calendar year for your fiscal year. You're only going to have 6 months of revenue history in 2019. 2020, you're going to have all 12 months. You're still going to have to show that you're 7.5% down in 2020 relative to 2019, and you're not going to be able to multiply that 6 months in 2019 by 2. You're going to just take the straight number, compare it to the 2020 number. This might be okay if you started, say, earlier in the year, like February or so. You've got 11 months of history. And then in 2020, you know, even though you've got 12 months, 2020, you were down a bit and you're down 7.5, you're fine. You can apply, you're good to go. But as you start getting later into 2019 and have a more incomplete revenue history for the year, it's going to be more difficult for you to make that threshold of 7.5%.
Okay. Is the program open to churches and other houses of worship?
It's not. They are, in my understanding, 501c3 organization who does not fall in one of these disproportionately impacted industries.
Okay. Are realtors eligible for the program?
They very well may be. They just would have to show a 7.5% decline in revenue from 2019 to 2020. And again, they're going to have to come up with eligible expenses, and they're not in one of the disproportionately impacted industries.
Question, if a person says, we have 8 companies of various sizes and have a common owner, can all 8 companies apply for a grant?
I mean, each one would be evaluated if they were eligible, but yeah. I mean, if they're all meet the eligibility requirements, they will. But we would look at each one of them would have to show a 7.5% revenue decline, would have to meet the SBA small business definition.
Okay.
One caveat there that's just important to mention: no entity with 0 employees assigned to it is eligible for a grant. You need at least 1 employee assigned to the entity. That might be important for some folks on here. The individual could be you on your 2019 tax return who is assigned to that entity, but there are sometimes, if it's a holding company or if it's an LLC formed for purposes of receiving rent to make mortgage payments for liability purposes or tax purposes or whatever, that's fine, not a problem. But just for the purposes of this grant, that is not an eligible entity to apply. You have to have 1 person.
Okay. If you use the grant to pay down an EIDL loan from the SBA, what documentation do you need to provide for this grant?
You would have to provide documentation from the SBA that shows you made that payment. The loan was cleared out, and somehow show to us that the money we gave you went towards that.
Okay. If a company received a PPP loan, can they also apply for this program?
Yes, as long as the PPP loan was less than $1 million.
Okay. My person says that their rent was deferred for 3 months and they used an EIDL loan to pay the rent. Is that covered?
If that's the case, I'm not sure I'm understanding exactly the situation, but you have to essentially pick. Like, you can refinance the EIDL loan, or I'd probably refinance the EIDL loan, because if you've then covered, you can't double count the rent payment you've rolled into the EIDL loan.
How are you defining revenue? Is that a line item on the tax return?
Yep, it should be the top line item on most tax returns. So it should be right there at the top before any expenses are deducted from it, even cost of goods. One question we have gotten, just to address here, is will a PPP loan be counted towards revenue for 2020? Our suggestion there is talk to your accountant. It's your federal tax return that we'll be using, and we'll just be taking whatever numbers on there. So ask your accountant how they're treating the PPP loan on your 2020 tax return.
Okay. What if you can you apply for this program if you don't have a if your business is based out of your home?
You can. You'll still be held to those same eligible expenses. You'll have to show that you incurred some of those eligible expenses. And in that case, your mortgage expense is not an eligible expense, even if you're a disproportionately impacted industry. So there's some, you might have a harder time coming up with those eligible expenses, but you could always. There's nothing to say. I mean, you should try to fill up your bucket, but it's not a requirement. It's not $0 or your full bucket. If you're eligible for a $40,000 grant, all you can come up with is $20,000 in eligible expenses. You can get $20,000. You just can't exceed your bucket.
Okay. Landlord had a question, said tenant failed to pay rent for 3 months. Is that lost rent an eligible expense?
For the landlord themselves, it would not be an eligible expense because that would be similar to lost revenue, which is not an eligible expense.
Okay. We own a vacation rental company. We had to implement a new linen program to protect our guests. Would this be covered?
You probably have to explain it a bit just to show, it was different and this is why it was new and we had to incur an expense we haven't incurred in the past. But it sounds to me, again, not knowing all the details, sounds to me like it's a decent example of equipment purchases due to COVID-19.
Do fixed expenses have to be accrued in order to be considered eligible?
If you're not in a disproportionately impacted industry, in which case rent can be counted, it has to be accrued. Yeah, it has to have been something you didn't pay and had added to your rent payments. Now, to be clear, say, April, May, your landlord didn't charge you rent, and now they've said your monthly rent payment is going to increase by $100 for the length of your lease. So June, July, August, now you pay that extra $100. That's $300 right there. And then, for the rest of the year, that extra $100 will also count towards it. If you actually, in that case, you can take out the entirety of, so even if that you're not paying off the full amount this year, your rent expense in April and May was $2,000 each, you'll have $4,000 to count towards the grant.
Okay.
But you have to be able to show it wasn't, your landlord didn't tell you you don't have to make the payment. It was in some way added to you're still paying it one day. Maybe you paid it in June. You paid the whole amount in June for whatever reason. It's still okay, but you have to have paid it. I mean, you have to have accrued it. Owe it.
If you're a nonprofit and you received a grant from the Delaware Community Foundation to cover extra expenses related to COVID, does this affect what you can claim as an eligible expense?
It doesn't, but again, if you're a 501c3, you will have to be in one of these disproportionately impacted industries to qualify.
Okay.
This is a good time. I know there might be more questions and what we can take them. We can, if people can hang on or I can go a little bit over 4:30, but it's a good time just to be up. I just want to be upfront with folks. 2 things that you'll have to sign as part of this grant process. I want to just explain why we're asking for them and don't want you to be caught off guard. You go and apply and why are they making me sign this? The first is we're going to make you sign a form. We're going to ask that you sign a form called the 4506T. It's an IRS form. What this allows us to do, it gives us authorization to pull your tax returns from the IRS. We're not going to do this as a matter of course with every business that applies. Go and pull your tax returns. We're going to, accept that the tax returns you are giving us are the tax returns you filed with the federal government. But it's added protection for the state and for you as a taxpayer, added protection against fraudulent behavior. So if we get a tax return that for whatever reason just looks like it was doctored, we can always go and pull the federal tax return, so it's backup. Or for the 2020 tax return, if for whatever reason people don't come back to us, report, rather than chasing them down for the money, we can pull their 2020 tax return ourselves, verify that they're under, and then pursue collection if there's a need to. The second form we're going to ask you to sign is a personal guarantee on the grant in the event that it converts to a loan. So this is really important. In the event you get the whole thing as a grant, and as I've said before, that is what I want for every single applicant, that your entirety, the grant we give you, you walk away and never owe a dime back to the state. If we're doing it right, that is what should happen. That personal guarantee will mean nothing. You will not have to worry about it. It'll be free and clear, cash in your pocket. But if it converts to a loan because you just weren't eligible, you didn't have the 7.5% revenue decline, or you didn't use it for an eligible expense, you're going to owe that money back to the state with interest, and you will be personally liable for that debt collection back to the state. So it's just really important, be clear when you apply that I can't stress enough. You want to be very confident when you apply that you're eligible before you accept the grant, that you're an eligible company. And then once you have the grant, that you use the money for eligible expenses, which you will know after the application process what those things are.
Question, what kind of documents can people start collecting now before the applications are open?
Big one is your tax return. Make sure you have your 2019 tax return. And we're flexible on the fiscal year. So we're just taking your federal 2019 tax return. So if your fiscal year is, I think most people will probably be January to December, that's great. If it's different, it's whatever your the 2019 version of your document was to the federal government. So whatever your 2019 fiscal year was. So make sure you have that. One of the ways, it's important just to kind of note here, one of the ways you might get snagged up in this process is by submitting an incomplete application. One of the most common ways that might happen is, say you accidentally submit your 2018 tax return. Unfortunately, if that happens, we're going to kick the application back to you. The volume's such with this program that we're not going to have the ability to kind of work with you and say, okay, fix it and keep going. We're just going to have our frontline reviewers flag that. It's going to get kicked back to you, and you're going to have to resubmit with your 2019 tax return, and you're going to lose your spot in line. Whoever was next in the review queue will start reviewing theirs, and when you come back, you'll go behind the last person who applied. So you really want to be sure that you give us the right documentation.
Okay. Question: if you're in a disproportionately impacted industry and your revenue doesn't drop by, or it drops by less than 7.5%, does it still convert to a loan?
It does. Yeah, it doesn't matter that you're in a disproportionately impacted industry. You still have to show that 7.5% decline. The only caveat to that is if you're a 501c3, because of the nature of revenue and the way your income is structured, we're not requiring you to show that 7.5% decline. But again, you do need to be in one of the disproportionately impacted industries, but that only applies to nonprofits, does not apply to for-profit businesses.
Okay. And in terms of disproportionately impacted businesses, can they file a claim for payroll and or insurance?
Not payroll, possibly insurance, though not health insurance, not employee-related insurance costs.
Okay. If you're not selected in the first round, can you reapply in the second or third round? Or do you have to reapply, or is it automatic?
No, you have to. We'll save your application, so you won't have to start from scratch, but you'll have to resubmit. And again, you won't get any kind of prioritization from having applied in the first round. You'll get a natural prioritization in the sense that by the time October rolls around, you'll already have done your application, so you'll be, on the first day ready to submit, but you won't get any kind of other prioritization.
Okay. Could you go over the NAICS code and give some examples? Code 8129, other personal services.
Yeah, so I don't have it right in front of me, but that's some of those other cosmetology services, like a nail salon or some of those services that were just completely shut down for several months, but similar to that cosmetology sector, I believe.
Okay. Okay.
You can find that on your tax return.
All right.
If you're wondering if you fall in that category.
Okay. if you are a startup and don't have employees, but you're in a disproportionately impacted industry, are you eligible?
As long as you have one employee yourself in the entity, you'd be eligible.
Okay. All right. I think we have time for one more.
Okay.
Does occupancy expenses for a disproportionately impacted industry, does it include utilities, rent, mortgage, or interest?
Sorry, yeah, it's just your rent payment or your mortgage plus interest. It's not a utility bill. That would not be an occupancy expense.
Okay.
It's your direct, it's really your rent, but I know some people pay a mortgage, so I say occupancy just to include that.
Okay. Great. Is there somewhere where people can go if they didn't, talk to at Division of Small Business if they didn't get all their questions answered today?
Yep. They can go to delbiz.com/contact and you can find information on how to reach out and get an answer to your question. Lauren Swain, who I believe is on here, is our Sussex County Business Manager and is glad to help answer your question. We are seeing, as you can imagine, pretty high volume right now. So we ask you to just be patient. She'll get back to you in a couple of days after receiving your email with an answer. I'm going to stop sharing, Gary, and just go through the questions real quick in case we missed anything. Just double check. Okay. Lots of questions about eligible expenses. Again, you can submit that to us and specific questions. We're glad to try to help answer. I think I just stress that we will turn those over to a third party who will evaluate them also. So we'll be trying to give guidance on what we think, but again, as you get into that gray area, we'll be relying on their suggestions. It's an accounting firm, so this is what they're experts in. All right. With that, sorry if I couldn't get to all the questions, but I think we're gonna end the webinar. Thanks for joining, and thanks for taking the time out to learn about this. Hopefully, it'll be of some assistance to you. Have a good one.